Welcome to this edition of All About Your Company. I'm Harsh Saita. Now, we've been focusing a little bit on the power value chain as well because power is likely coming back in a big fashion given the focus that's happened in West Asia as well as what the summer holds for us going forward. And TD Power is one of those within that value chain which looks interesting, which is why we've picked on this one today. And the second piece is the fact that when you're looking at the stock price itself, let's pull the 12-month stock price up. And what you'll see is it's been a doubler over the last 12 months. And even in the recent correction, you've not seen much in terms of the correction. Just look at the blip. It's just been about a 10% blip that we've seen. And thereafter, the stock has rebounded quite sharply. So we've seen a very decent kind of a move and a very good hold up with regard to the stock price as well. In fact, this one over the last 5 years has been, guess what, a 31 bagger. Over the last month, it's done 22%. And over the last 6 months, it's up 52%. So we've seen a very strong rally in the stock price. And that's the other reason why this kind of throws up on our radar. The third piece is that among power generating companies or the companies which are manufacturing generators and motors, really this one stands out. One from a uniqueness perspective, and second, it is also one of the cheaper companies available out there despite the rally in the stock price. So multiple reasons why this one looks interesting. But let's take a step back. Let's look at what the company is all about. It was incorporated in 1999. It's a company which designs, manufactures alternating current generators and motors. I'll talk to you a little bit about what generators are, what motors are, to kind of give you a perspective. So they do designing, manufacturing of alternate current generators and motors. Power generation, industrial, railways, oil and gas sectors is where some of their products are used. Now let's talk a little bit about what a generator is. A generator, very simply put, it's a device which generates electricity from a spinning fan, for example. So whenever there is a device which spins, the electricity which comes out of it, the device captures the electricity. It's essentially what a generator is. What's a motor? It's the exact reverse. It actually converts electricity and powers the fan. So it plays in reverse order. So what TD Power does is it produces and manufactures generators and motors. It designs as well as manufactures, and it custom designs it as well. So that's where TD Power is unique versus many of the other companies. Now let's talk about products and services, and you'll see a whole host of them on your screen. Steam gas turbine generators is what it manufactures, gas and diesel engine generators, hydro and wind turbine generators. So across the generator value chain, you're seeing geothermal, solar, hydro, gas, diesel, steam, all of them is what they is what they're able to manufacture. Now let's talk about the motor side of things. Induction motors, I mean, they're used in even your basic fans, right? In your ceiling fans as well. So that's what induction motors are. And large synchronous induction motors. Now, these are crucial. These are used in industry. And they are induction motors which go only at one pace. Because if the pace were to change, then the machinery will go haywire as a result of that. So they manufacture these large synchronous induction motors, and that is what they supply to industry. And we'll talk about their customer cohort, etc. But you'll get a sense of what they do. Traction motors, spares and replacements within the entire value chain. They also do associated services, which is after sales, maintenance, setting it up, all of that. They do not do EPC. That's not something that they ventured into, and that's why what they've stuck to is the manufacturing piece, and even within the manufacturing, generators and motors. That's broadly the way to look at this. Now let's look at the business model. They win orders, which is largely B2B orders. They design, engineer, manufacture, and deliver. In the process of that, they have manufacturing facilities in India and Turkey. I'll talk to you about how they work on their sales. That's a separate slide for us. The recurring revenue comes from services, spares, and refurbishments. They sell to customers across India as well as abroad. and the raw material. This is a key component. Copper and steel is what they depend on for the purpose of raw material. Their customer profile is turbine and engine OEMs, which is original equipment manufacturers. Utilities, industrial plants, railways is also what they supply to. Some of their fancier motors are what go in utilities, industrial plants and the like. In terms of customers, Voith, Siemens, Alstom, General Electric, sugar factories, for example, cement, steel plants, oil and gas companies, data centers, hydroelectric and thermal plants, and Indian Railways. They supply to all of these. It's just some customers specific names, and then you have those entire bunch of sectors who they supply to. Now let me talk about geography. FY25, they had 64% of their revenue come from exports and 36% from domestic. That has switched sharply. 79% exports, 21% domestic in 9-month FY26. And in fact, their order book also is largely 70-30 now in terms of domestic to export. If I were to include the domestic railway component of the order book as well. So broadly, that's the split. The tilt is sharply towards exports where margins are better and currency tailwinds also come through. Let's talk about the presence. And US, Europe, Turkey are just some of the places where they are present. They are also present in terms of global installations. They've done installations in 111 countries as of December 2025. So very, very wide geography that they cater to. In fact, if you go to their investor deck, they have one slide where they've actually put up all the continents that they've serviced, and they pretty much cover all of the globe. 57 global service centers is what they have. Now let's talk about the metrics, and we'll again take a step back, look at the last 3 years and see what TD Power has done. In terms of top line growth, we've seen a decent 17% growth, but what's really impressed is the fact that the EBITDA compounding has happened in a very sharp fashion. You've seen EBITDA compound at 34% over the last 3 years, PAT compound at 36%. So you've seen very, very good growth tailwind come through. As a result of that, you've seen the re-rating on the stock price as well. Let's look at the 9-month performance, and the 9-month performance has been very impressive from a growth perspective. 36% is what it's clocked in terms of 9-month growth. It's done nearly the whole of last year's top line already this year. The guidance is they'll do 1,800 crore of top line this year, FY26. EBITDA, 41% growth there, and net profit, we've seen a 37% growth over the last year. We've seen a very sharp 500 BIP expansion in terms of EBITDA as well. So you've seen a very, very decent set of numbers come through. Now let me talk about the margin trajectory. The margin trajectory, you'll see it on your screen. It's gone from a 12%, 12.5% margin to around an 18% plus kind of a margin number. And that's where it is likely to sustain. And this is broadly the way in which margins have shaped up. Now, now let's look at the order book if we can. Let's pull out the order book, and within the order book, what you'll see is 1,845 crore order book. They've done around 1,600 crore of revenue trailing 12 months. 1,800 crore is what they're expected to do FY26. So it's around a 1 to 1.2 time book to bill. That's broadly the visibility in terms of order book, and that's broadly normal because execution happens over 6 to 12 months. So your order book execution has to happen in the next 6 to 12 months. That's broadly the way it works. And then there's order book accrual, which happens. So that's the way to look at order book. Both of those looking comfortable, a thumbs up on both of those. You look at the balance sheet, around 1,000 crore is the book value. So it trades at 15 times book. That's something that you want to keep in your mind in terms of the valuation. But the borrowing number is at 36 crore. Absolutely very, very low in terms of borrowing. So no concerns there whatsoever. Have to give this one a thumbs up as well in terms of the visibility on the balance sheet front. In fact, the cash also that they hold is around 200 crore, which is decent, not half bad at all, given that it's a 1,000 crore balance sheet. Cash flow is the problem because working capital is what is occupying a large part of that cash flow. So free cash flow hasn't come through. They've been focusing on growth, and they've been reinvesting the surplus into working capital, which is the requirement. Inventory and receivables is where a lot of that money is sitting, and therefore that conversion hasn't happened. We're cautious with regard to that particular piece, and therefore cash flow, we've given it a neutral. Let's look at return ratios, and it's very strong, especially post that lift in terms of margins. We've seen very, very good return ratios come through. Thumbs up there, no concerns. You're looking at shareholding pattern. promoter holding has shrunk because one of the promoters has been reclassified, and which is why you've seen that very sharp shrink in promoter ownership. It was above 50% till March 2023. So that shareholding is not seen here, but it's fallen now to 27% because of that reclassification. FI's, DI's interest has gone up in the company as the market cap has risen, and you're also seeing public participation there. Now, in terms of, before I get to valuations, let me quickly also cover analyst recommendations. And there are 3 buy calls, 1 sell call, no holds, and 124% upside. So another doubler is what is the way analysts are seeing this in terms of valuations. And I won't delve too much upon this because there's just 4 analysts tracking it, and therefore we've given this a neutral. But you look at valuations now. FY27, the revenue is expected to be at around 2,200 crore, margins at 18.5%. We've extrapolated the PBT to be around 400 crore, and the PAT at a 25% tax rate sits at around 300 crore. Therefore, giving you a price to earnings multiple FY27 of 51 times. So those are all the assumptions we've made based on the guidances given on con calls and in the PPT, very clearly disclosed, by the way, viewers. So that's something that you look out for. Revenue, the guidance given is that 2,200 crore number is conservative. That's what they have suggested. And we'll obviously speak with management, try and understand what the forward-looking kind of numbers look like. We won't speak FY26, of course, but we'll try and get a perspective of how this plays out. Now, let me bring on board the management. Nikhil Kumar joining us, Managing Director at TD Power Systems this afternoon. Great speaking with you, Mr. Kumar. Let me first start off by trying to understand the current headwinds with regard to copper and steel. You've said that likely the pass-through will start to happen pretty much immediately on the new contracts that you're signing. On the old contracts, you were already sitting on raw material of copper and steel, and which is how you were servicing your current order book. But talk to us about the new order book. Are you able to pass through those higher costs to customers, and how easily are customers absorbing that cost? Give us a sense of that to start off with.
Yes, so our customers are fully aware of what's happening in the commodity markets, and the pricing of copper is a very important part of our pricing that we give to them. We have already passed on the cost to our customers, and we will see the impact of that additional pricing already coming into our margins from this quarter onwards. When I say Q1 of this year. So I'm not I'm worried at all. We had inventory, so whatever inventory we had at lower prices, that held us through while we were negotiating. And after we negotiated, and once new prices are in place, we're seeing that pass through taking place, so there won't be any impact in the margins. And that's what we always do. We always hedge. We always hold inventory. And that's the reason it gives us some amount of time to work through the system to get the new pricing in effect, and then see the impact on the numbers a little bit down the line. So that's a conservative approach that we take. And so while we have to hold additional inventory, it affects the free cash flow, but it protects us when situations like this occur. And I think overall, it's what's important for us is margins and protection of margins.
Point taken, Mr. Kumar. But what happens to your existing order book? So at the end of Q3, your order book stood at 1,845 crore.
That's largely hedged.
You don't get a repricing, right?
No, those are largely hedged. And that's the reason why we hold so much of material in the factory. And that's the reason why we don't see the impact on that.
Understood. And the forward orders, you're getting a price pass through on that, and your customers are comfortable with that. Is that the right way to think of it? Okay.
Yeah.
Perfect. All right.
It's obvious that everyone knows the copper prices are up by 35%, right? So everyone knows.
Sure. Talk to us about order pipeline. I won't talk about FY26, but give us the sense as to how traction is building up, because domestically you are penciling in a growth of 10 to 12%, but you want to grow at around 20% on your top line for the foreseeable future. At least that seems to be in the commentary. I mean, you've not stated it, but that seems to be in the commentary. Talk to us about how much is order visibility playing out in terms of what are you seeing on ground in terms of export order visibility?
The situation is extraordinarily strong. That's all I can say. Unfortunately, I'm not able to give numbers because we're in the blackout period, and I don't want to. I'm not allowed to give numbers. But all I can say from a qualitative point of view, the situation is extraordinarily strong, and there is a large inflow taking place and continues to take place. The pipeline is extraordinarily strong, not just I'm talking about all sectors. It's whether it's gas engines, gas turbines, steam turbines, hydro. We're seeing a pretty extraordinary situation. We're very well placed. Most of the business that we're getting is export. The domestic market is still relatively subdued and it's steady. I would say, I don't want to say subdued, I would say relatively steady. 10-12% growth still continues, but most of the action that's taking place in the power generation is happening outside India, and TDPS is right in the middle of all the action taking place, and we're seeing a pretty extraordinary situation, as I said, with our order book. So we are under tremendous execution pressure, continue to be under tremendous execution pressure. Like you mentioned a little bit earlier in the opening remarks, that the guidance that we've given is conservative. It is certainly conservative. When we have the earnings call at the end of in May, on May 14th, after the board meeting, I will give the first upward revised guidance for this current financial year. And as I said, right now we are all under tremendous execution pressure, tremendous.
Okay, I mean, I underline that, I double underline that, and point noted. Talk to us about, therefore, capacity. Your capacity currently sits at around 2,400 crore in terms of top line, 600 crore run rate quarterly. That's my understanding. Does that mean you go full throttle in terms of capacity going forward? Give us a sense. And what's the pipeline in terms of capacity increases? How quickly do you get there?
So we had originally planned our capacity with the new expansion that we had in place to take us to around 1,800 crore, but we have already hit 1,800 crore. Based on the guidance that we gave for last financial year, based on the old capacity. So the new capacity now we are saying will take us to about 2,627. But look, I've always said that we have land, we have money, we know what we're supposed to do, and we take a decision to add more capacity if we see this trend going forward into FY28. And all indications are looking like we will have to add another round. And I will be taking that decision very soon because the demand is extraordinarily strong, continues to be strong, and we will probably take a decision very quickly to put another round of capacity expansion to take it to maybe 3,200 or something like that. So that's not yet decided completely. It will be discussed in the board meeting on the 14th of May, and then we will inform the market about what the company has decided to do.
Okay, and Mr. Kumar, I must say that, is there a cyclicality risk to the business at all? I mean, we've seen it in the past. I know that currently it's blue skies for you, but what if the scenario were to reverse or shift? What plays out then? Because you're sitting on this very large capacity, you're looking at an expansion further. What happens then?
Yeah, that's something that is always at the back of our minds, right? So adding capacity is a very easy decision to take, and then the question is that how long is the cycle going to last, and what are you going to do when the cycle turns? So these are questions that we ask ourselves 100 times before we put that money on the table to put capacity. Because as I said, putting capacity is easy. Filling up the capacity and sustaining it is not always in our hands. So the first attempt is obviously going to be from our side to see how we can flog the existing assets to the maximum possible level, so that we're not adding capacity, but actually working with a very high capacity utilization, high efficiency, and getting good margins from using our assets in the best possible way. That's the first attempt. But now coming back to the cycle, right? So this cycle is a little different from previous cycles, I can say, in the sense that this cycle is driven by two major things taking place in the world markets. I'm not talking about so much about India. One is, of course, the artificial intelligence and data center requirements from artificial intelligence, which has put an enormous amount of power requirement in the United States right now. But other countries are also going to put up a similar kind of capacity because everybody wants to have their own AI processing in their own countries. It's going to be a thing which is going to happen in the future. So the amount of electricity you need for this is just staggering. That is, and that cannot be fulfilled even in the next 3 to 4 years. So at least 5 years, the pipeline for the U.S. market alone is extraordinarily strong. Then you have this renewable push. Then you have grid stabilization opportunities. Then you have reconstruction of war-affected countries, power requirements from those countries. So generally the underlying factors are pointing towards a cycle, a little different kind of cycle. This is not a typical cycle where we are also focused only on a single country. We're not depending only on the Indian cycle, for example. We're talking about the world market. We're talking about being in multiple countries and multiple businesses from multiple countries. So we're less exposed to a single market, single cycle. And you also take a look at what other large people in the industry are doing. The large guys, like the big guys like Siemens and ABB and General Electric. So if you look at what they're doing, they're all putting huge amounts of money in capex, staggering amounts of money in capex, and so we are of course much smaller, much smaller, but we're still part of the same market, and if they're doing it, they have probably much better access to information, even more than what we have. And so we take our leads from them too in many ways.
Yeah, that's going to be critical, right? How does competition also behave in an environment like this? What's the China competition factor looking like? Because a big player coming in, completely changing the environment, the pricing, the structure, how likely, how possible is that, and how much of a play can China make on this?
China is not really in this segment very strongly. First is China is pretty much overbooked with their own AI and own power generation capacity in their own markets. So most of the Chinese players are completely booked out over there. Second is that most Western companies have I would say, are not currently buying Chinese products in the markets that we operate in and are hesitant to really expose themselves to China given geopolitical issues. So while China is, of course, always a country that we view very seriously from a threat point of view, right now they're not so much on the scene. On the larger companies that we compete against, yeah, they are all putting in additional capacity, but you see the larger companies are putting in capacity for the larger sizes of the machines, above 100 megawatt, and we operate mostly below 100 megawatt. So even if they put capacity, there are a lot of advantages that the market has working with us, and we are part of the business. I think will continue even if the larger companies put up capacity, because we have our niches where we are pretty strong, and we don't see a threat from large Western companies in these segments. But having said that, competition is competition, and one has to always be alert.
Sure. Mr. Kumar, you suggested a couple of times in this interview, you reiterated on the fact that that the kind of capacity utilization and execution pressure that's there on the company is extremely large. Say you were to push the accelerator fully on your current capacity, what's the potential top line that you can pull out of the kind of capacity that you currently hold? My understanding is 600 crore quarterly, but I'm saying if you absolutely push it, is there absolutely any chance of that going up, or is it a flat 600 crore with a hard
It's a
ceiling?
really good question. It's a really good question, but I'm not going to be able to answer that today because of numbers, right? I
Okay.
can't give those things out in terms of numbers. But you're
No,
in
but sir, this is not forward-looking.
generally what you're
This is
saying is absolutely the reality.
sure,
Uh,
sure.
and but the market is going to force me to do what you're saying. And
Right.
what market? I don't mean the stock market. I mean my customers, right? Um, so we are going to be forced to push out larger numbers this year based on the higher order inflow taking place. And what that number is going to be, I'm sorry, I can't say it today, but it's going to be, I have to talk about this only after the board meeting. But in general, what you're saying is right. We will have to push ourselves further.
And 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 my understanding, therefore, Mr. Kumar, from what you imply is you can push it above 600 crore.
Yeah,
At least that's
yeah, we
my
have to.
understanding.
Absolutely.
Sure.
I mean, we have no choice. Um, the market is there. Our customers are sitting on us, asking for more machines, and we have to deliver. Simple, and we will.
Perfect. Thank you so much. This has been a very good interaction. It gives us a great lens into the industry as well as TD Power in particular, and a bullish tone just kind of gives us a sign of what things to come really look like. But we will speak with you, Mr. Kumar, post the Q4 earnings, and we'd love to have that revised commentary come through and try and analyze and break it down a little bit further. Thanks so much for joining us this afternoon. And viewers, that's all from our side here on the show. Everyone who puts this show together, thanks so much for watching. Stay tuned to ET Now. More action on the other side.